I'm Doris. I'm here to share with you about my stock account. Today, my stock account has made a loss of $1,700. The Fed has suspended raising rates but hinted at mixed gains in the future. So let's first take a look at my account. Today, United Natural Gas made a loss of 0.62% in the post-market, and SQQ made a loss of 2.18% in the market. In total, today's PL is a loss of $1,529, which is a loss of 2.21%. Right now, the net asset of my account is at $67,709.71. Today, the market closed mixed. Nasdaq Composite closed up 0.39%, S&P 500 closed up 0.08%, and Dow Jones Industrial Average closed down 0.68%. Today, the healthcare industry closed down more than 6%, while the semiconductors closed up to 2.46%. The S&P 500 and the Nasdaq hit a new 13-month high. The Fed suspended raising rates but suggested more in the future. Mr. Powell said July policy meeting would make a further decision based on the situation. Markets are abandoning their bets that the Fed will cut interest rates this year. After 2 days of the meeting, the Fed announced its resolution and monetary policy statement at 2 p.m. Eastern Time on Wednesday. The Federal Reserve suspended raising rates and left its benchmark interest rate unchanged at a range of 5% to 5.25%, ending its 10th consecutive rate hike since March 2022. Members agreed on the rate decision, statement said. Keeping interest rate unchanged allows the FOMC to assess more external data. Inflation remains high. The committee remains highly concerned about the inflation risks. Job growth is strong. The unemployment rate is still very low. Further tightening of policy will depend on economic conditions. The dot plot of the Fed's forecast for future rate hike paths shows that the median interest rate forecast at the end of 2023 is 5.6%, up from 5.1% previously. The Fed's dot plot shows that 12 Fed officials expect rates to rise to at least 5.5% to 5.75% this year. 4 expect another rate hike to rise at least once this year. The only 2 think no more. The Fed said the committee was firmly committed to returning inflation to its 2% target. Inflation remains high, and the policy-making committee remained highly concerned about inflation risk. The Fed also raised its forecast for the U.S. economy this year. The FOMC economic forecast shows that the median GDP growth forecast for the end of 2023 and 2025 is 1%, 1.1% and 1.8% respectively. Fed Chairman Jerome Powell later told a news conference that he was firmly committed to meeting that only the 2% inflation target. Almost all policymakers believe that the further interest rate should be appropriate this year. Mr. Powell said housing activity remains weak. Most policymakers expect moderate growth in the economy to continue. The labor market is still very tight. Housing market activity remains weak. Most policymakers expect moderate growth in the economy to continue. The labor market is still very tight. Mr. Powell said, "We're highly concerned about the risk to the Fed's dual mission with the high inflation. Full effect of monetary tightening will take time to achieve, especially on inflation. The economy faces headwinds from tighter credit." Mr. Powell says the next policy meeting in July will make further decisions based on the situation, keeping the possibility of a rate rise then. The decision has not been made, Mr. Powell said in a news conference. "I do expect this meeting to be flexible based on the situation." Although the Fed suspended, but it could be a very brief pause, raising median interest rate forecast by 50 basis points to 5.6%. The Fed remaining hawkish surprised investors. Mr. Sam Strobel, chief investment strategist at CFRA Research, says the market has already sold off as investors worry that the Fed will raise interest rates at least 2 more interest rates from now until the end of the year. Some had expected the Fed to pause raising interest rates this month and never raise interest rates again because rates are high enough, while others think they will pause the interest rate at the meeting, but could raise rates again in July before ending the rate hike cycle. However, since the last meeting, FOMC members have become more hawkish, which I think has surprised investors. Fitch noted that the Fed was far from convinced that its task of raising interest rates was completed. Fitch chief economist Brian Coden said in a note that a summary of Fed officials' economic expectations suggests 2 more interest rates this year. The Fed's latest economic forecast summary raised rate at the year-end median federal funds rate to 5.6% from 5.1%. Both expectations and dot plot suggest that there will be 2 more rate hikes this year, with a maximum rate of 5.75%. That is consistent with the Fed's upward revision of its core inflation forecast. With core inflation proving to be so stubborn, the Fed seems to be less confident about whether it has done enough to curb inflation. Interest rate swaps tied to the Fed's duration now expect the policy rates to peak at 5.32% in September and jump to about 5.23% in December 2023. On Wednesday morning, the December contract rate is about 15 basis points below the expected peak, meaning a maximum cut of 95 basis points. Long-term interest rate contracts suggest the Fed will ease policy in 2024. After the Fed announced the interest rate decision, CME's Fed Watch tool showed a 29.6% chance that the Fed will keep rates unchanged at 5%. Investors are generally optimistic before the Fed's raising interest rates. The VIX closed at 14.6 early Wednesday, now nearly its lowest level in 3 years. Analysts at Benchmark Investment Group said such signs of optimism about investors could conflict with poor market performance in the wake of the recent Fed announcement. They said, in the recent days when the Fed announced several monetary policy decisions versus impacts, the S&P 500 fell more than 1% in the day after the Fed announced its last 6 monetary policy meetings. The declines occurred merely on the last hour of trading after Fed Chairman press conference. Even normally bullish analysts are very wary of the possibility of stocks falling in the short term, especially if it's about Powell stresses that the pause doesn't necessarily mean borrowing costs have peaked this cycle. Fundstrat Tom Lee, head of research, said this could be a hawkish pause because the Fed could be plagued by a 15 rally so far this year. This is a possibility. The Labor Market Department reported that PPI rose 1.1% in May from a year earlier, compared with 1.5% rise and 2.3% versus last month. The PPI fell 0.3% month-on-month compared with 0.1% fall and a 0.2% rise. Investors are encouraged that the PPI is 0.3% month-on-month decline in May. The third decline in the past 4 months could signal a further slowdown in inflation later this year. Excluding more volatile food and energy costs, the core PPI was flat in May from the previous month, with a year-on-year growth falling back to 2.8% from 3.3%, the smallest gain since February 2021. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.